softwood lumber market has been in a rebalancing phase through much of 2026. Compared to the oversupplied market we saw last year, supply is realigning much closer to underlying demand. We saw a sizable wave of sawmill curtailments and closures in 2025 in response to weak prices, and at the same time, imports pulled back meaningfully, especially from Canada and Europe due to higher duties and tariffs, along with other market pressures. As a result, North American sawmill operating rates are starting to recover, which helps explain the gradual upward trend in many dimensional prices we're now seeing. What's also different from 2025 is the nature of those price moves. Last year was highly volatile, driven by uncertainty around the magnitude of Canadian duty increases and new potential tariffs that were being announced. That ultimately created sharp swings in trade flows and market prices. In 2026, the market is still gyrating and adjusting from those disruptions, but the moves have been much more measured and grounded by the fundamentals of demand and supply. The energy shock tied to the Iran conflict is having several knock-on effects across the wood products markets. The most immediate and obvious impact is from higher fuel costs. Loggers are getting squeezed by higher diesel prices and have limited ability to pass those increases downstream, which is forcing some to scale back or pause operations. At the same time, fuel surcharges are pushing flatbed rates higher, increasing delivered costs and tightening market liquidity. Ocean freight rates have also moved up, adding another layer of pressure for imported wood products that are already grappling with tariffs and slower demand. Less obvious, but just as important, is the impact from petrochemical supply chain disruptions, which have pushed up the cost of resins and waxes. These key inputs to wood panel production have translated into some of the largest single-week price increases we've seen for products like particle board and MDF. On top of the cost-push inflation the wood products industry is dealing with right now, rising energy and petrochemical costs feed into broader inflation, which is now over 4% in the US. That acts as a tax on the consumer, reducing discretionary spending, and will ultimately weigh on housing and wood products demand down the line. AI-driven investment is becoming an increasingly important macroeconomic factor for wood products, mainly through its indirect effect on housing. We're seeing massive investment on the order of $600 to $700 billion in 2026 alone, flowing into data centers and related infrastructure. That's supporting headline economic growth, even as we are seeing signs of a flagging US consumer. But that same capex spending is also creating competition for key inputs like land, labor, and capital. As home builders are increasingly competing with data center development for these resources, their costs remain firm or are even pushing higher. Home builder margins have already been under tremendous pressure from cooling home prices, rising buyer incentives, and elevated material costs. Rapidly accelerating AI investment that further bids up the cost of key inputs like contractors, freight, and lots probably means that on the margin, home builders will cut back production to focus on more profitable business. That will ultimately translate to softer demand for wood products over the horizon. Our outlook for North American end-use demand is generally flat for 2026, with a re-acceleration expected in 2027. The challenge this year is the number of headwinds hitting residential construction, which drives about 70 to 80% of North American wood products demand. Inflation, elevated interest rates, tariffs, and the energy shock are all weighing on affordability and discretionary spending. Single-family construction, which is highly rate sensitive, is expected to decline this year. Repair and remodeling is a bit more resilient. We do see pent-up demand here, and will probably continue to grow in 2026, but it's not going to be enough to fully offset the overall weakness we're seeing in new construction. Other segments like pallets should see some growth as well, but they're not large enough to really move the overall wood products market. Looking ahead, we expect that easing inflation, particularly if energy markets stabilize, will help bring interest rates down, improve affordability, and support a recovery in both new construction and further bolster renovation activity in 2027. Policy uncertainty has been a major theme for the past 12 to 18 months and remains a key factor for the wood products outlook. On the trade side, we've seen a wave of new wood product tariffs since 2025. That includes the 10% Section 232 tariffs on imported softwood lumber, as well as ongoing volatility tied to investigations and rulings affecting products like Brazilian plywood. At the same time, the removal of certain exemptions has expanded tariff exposure to a broader set of wood products from around the globe. There's also an open question around the longevity of USMCA as negotiations between the three member countries are underway. This brings into question whether Canadian wood products will remain exempt in the future from these broader trade measures the US has begun to employ more aggressively. The key variable to watch is mortgage rates. We haven't seen much relief there recently, largely because inflation has been reaccelerating, driven by factors like energy prices, tariffs, and broader industrial demand tied to the data center boom. If those inflation pressures start to ease, especially if the ongoing energy shock tied to the Strait of Hormuz subsides, we should see some downward pressure on interest rates. That would improve housing affordability and free up discretionary income for consumers. That's ultimately what will unlock a housing recovery. We're already seeing some encouraging signs in repair and remodeling. Our Fastmarkets RRI is showing decent momentum over the last 12 months. But for a recovery in wood products demand to materialize, we need new construction to participate as well. After 5 straight years of declining wood products demand, the path forward really depends on rates stabilizing that will catalyze reacceleration in residential investment.